Let's continue our series on financial ratios used to assess insurance companies. Today, we're looking at one of the most important indicators of all, the Capital Adequacy Ratio. This ratio answers a very simple but powerful question. Does this insurance company have enough capital to absorb losses and still survive? If you understand this ratio, you can quickly tell whether an insurer is financially strong, vulnerable, or at risk. Question 1. What is the Capital Adequacy Ratio? Let's start with what it means. The Capital Adequacy Ratio, often called CAR, measures how much capital an insurance company has compared to the risks it has taken on. It is a key measure of an insurance company's financial strength and tells us how well an insurer's capital compares to the level of risk it has taken on. In simple, everyday terms, CAR answers this question. Does this insurance company have enough financial muscle to handle losses if things go wrong? The ratio shows whether that cushion is enough. An insurer with strong capital can absorb unexpected large claims, survive economic shocks, and continue paying claims even in difficult years. Think of capital as the insurer's financial cushion or safety net. It is the money set aside to protect policyholders. Risk, on the other hand, represents the potential future losses the insurer may face from claims, market movements, operational failures, or unexpected events. The Capital Adequacy Ratio brings these two together. It shows whether the insurer's cushion is thin, adequate, or comfortably strong. Question 2. Who sets the capital adequacy requirement in the insurance market? In the Kenyan insurance market, capital adequacy requirements are set and enforced by the Insurance Regulatory Authority, IRA, under the Insurance Act. The IRA has the legal mandate to protect policyholders, promote insurer solvency, and maintain stability in the insurance sector. While international bodies, such as the International Association of Insurance Supervisors, IIS, provide global principles and best practices on solvency and capital management, they do not impose binding capital ratios on individual countries. At the national level, the IRA determines Kenya's capital adequacy framework by considering local market conditions, the risk profile of insurers, and international guidance. This ensures that capital requirements are appropriate for the structure and realities of the Kenyan insurance industry, rather than being a one-size-fits-all global standard. Practically, the IRA defines minimum capital and solvency thresholds, oversees the market's transition to risk-based capital, RBC, monitors insurers through regular reporting, and takes supervisory action where capital levels fall below required standards. As a result, capital adequacy in Kenya is not optional. It is a core regulatory requirement designed to ensure insurers remain financially strong and able to meet their obligations to policyholders. Question 3. Why does the Capital Adequacy Ratio matter? This ratio matters because insurance is a business of uncertainty. Claims can spike due to natural disasters, medical inflation, court awards, and economic downturns. Capital is what protects policyholders when things go wrong. An insurer with strong capital adequacy can absorb unexpectedly large or catastrophic claims, withstand economic shocks such as inflation or market volatility, continue paying claims even in difficult years, and operate with confidence over the long term. On the flip side, an insurer with weak capital may struggle the moment claims spike or conditions worsen. A weak capital position means delayed claims, regulatory intervention, restrictions on new business, and, in extreme cases, collapse. So when we talk about the capital adequacy ratio, we are really talking about resilience, the ability of an insurance company to keep its promises, no matter the circumstances. And that's why CAR is one of the most important indicators used by regulators, corporate clients, investors, and risk managers when assessing an insurance company. In Kenya, capital adequacy is a regulatory requirement, not optional. That's why regulators, corporate clients, and investors all pay close attention to capital adequacy. Question 4. Where does one get the data to calculate the capital adequacy ratio? Reliable sources include: Number 1. Insurance company annual financial statements. Number 2. The Insurance Regulatory Authority reports and publications. Number 3. Audited annual reports of listed insurers from company websites or Nairobi Securities Exchange website. Once you get any of the reports above, look for capital or shareholders' funds, solvency or capital adequacy disclosures, minimum capital requirements, solvency margins, and risk-based capital compliance. Always use audited and published figures. These items from the reports will help in calculating the capital adequacy ratio. In the next topic, we demonstrate how to calculate the capital adequacy ratio. Question 5. How is the capital adequacy ratio calculated? Let's make this practical. The simplified formula is: capital adequacy ratio equals available capital divided by required capital. Or, under risk-based frameworks, capital divided by risk-weighted assets. In Kenya, capital adequacy requirements set by the Insurance Regulatory Authority mandate a minimum capital of specific amounts, e.g., 650 million Kenya shillings for general insurers, or 400 million Kenya shillings for life insurers. For illustration purposes, let's assume that available capital for a particular general insurance company is 1 billion Kenya shillings against the required capital of 650 million Kenya shillings. To get the capital adequacy ratio, divide the available capital of 1 billion by the required capital of 650 million, and that gives you 1.54. In short, 1 billion divided by 650 million equals 1.54. You can then multiply this answer by 100% to change the presentation into a percentage. This means the insurer holds 154% of the required capital. In other words, it has a healthy capital buffer. Insurers are required to at least maintain a ratio of 100% of required capital, but often aiming for 200% of minimum capital under risk-based supervision, RBS, to ensure solvency and cover insurance, market, credit, and operational risks. Question 6. How are the capital adequacy ratio results interpreted? This is where the real insight comes in. The capital adequacy ratio is not just about meeting a number. It's about understanding what that number says about an insurer's strength, resilience, and risk appetite. Let's break down some of the outcomes clearly. Scenario number 1. Capital adequacy ratio of below the regulatory minimum. This high risk and represents a serious red flag. It means the insurer does not have enough capital to support the risks it has taken on. In this position, the insurer may struggle to absorb losses, claims paying ability could be compromised, regulatory intervention is likely, and restrictions on writing new business may be imposed. For clients and policyholders, this level signals heightened risk, just above the minimum requirement. Scenario number 2 is adequate but fragile. Here, the insurer technically meets regulatory requirements, but only just. This means there is limited room to absorb unexpected shocks. A single bad loss year could strain the balance sheet. Close monitoring is essential in this scenario. While not immediately alarming, this position requires strong risk management, careful underwriting, and effective reinsurance to remain stable. Well above the minimum requirement. Scenario number 3. Strong and stable. This is generally the most comfortable and desirable range. At this level, the insurer has a healthy loss-absorbing capacity. Claims-paying confidence is high, and the company is well-positioned to support large, complex, or long-term risks. For corporate clients and procuring entities, this level of capital adequacy provides reassurance and reliability. Scenario number 4. Very high capital levels. This represents a very strong position, but watch efficiency. Extremely high capital adequacy indicates an insurer is exceptionally safe. However, there is a balance to be struck. While the insurer is highly resilient and policyholder protection is very strong, it may also suggest underutilized capital, lower return on capital, and potentially less competitive pricing. In this case, the insurer is very secure, but may need to improve capital efficiency without compromising stability. The capital adequacy ratio is not about chasing the highest number. It's about maintaining the right balance between safety, resilience, and efficiency. Understanding where an insurer sits on this spectrum helps clients, regulators, and insurers themselves make better, more informed decisions. Question 7. What do these different capital adequacy scenarios mean for different stakeholders? The interpretation and application of capital adequacy ratio results vary across different stakeholder groups, particularly when it comes to practical action points. While the ratio itself is a single number, what it means and what should be done about it depends on who is looking at it. Corporate clients, regulators, and insurers each use capital adequacy information differently, guided by their unique objectives, responsibilities, and risk exposures. Understanding these differences helps ensure that capital adequacy results are not just observed, but used effectively to drive informed decisions and appropriate actions. Number 1. Corporate clients. For corporate clients and procuring entities, capital adequacy should be a key decision factor when selecting an insurer, especially for engineering risks, medical schemes, group life policies, and public sector covers. A strong capital position provides confidence that the insurer can withstand large or unexpected claims, honor long-term commitments, and support complex risks without financial strain. In essence, it reduces counterparty risk and ensures continuity, reliability, and peace of mind beyond just competitive pricing. Number 2. Regulators. For regulators, the Capital Adequacy Ratio is a critical supervisory tool. It helps identify insurers that may be financially vulnerable at an early stage, allowing for timely intervention before policyholders are affected. By monitoring capital adequacy, regulators can enforce corrective actions, safeguard policyholder interests, and maintain overall stability and confidence in the insurance market. Number 3. Insurance companies. For insurers themselves, capital adequacy directly influences strategic and operational decisions. It determines how much risk the company can underwrite, the level and structure of reinsurance arrangements, the design and pricing of products, and the insurer's ability to grow sustainably. A well-managed capital position supports long-term resilience, responsible growth, and stronger trust from clients, regulators, and investors alike. The Capital Adequacy Ratio is about one thing: ensuring insurers can survive losses and still keep their promises. It protects policyholders. It disciplines insurers. And it builds confidence in the insurance industry. This is why capital adequacy is not just an accounting number. It is the backbone of insurance stability. That marks the end of our discussion on the Capital Adequacy Ratio. In our next video, we continue this series by exploring another key financial ratio used to assess insurance companies. If you found this useful, please like the video and share it with your network. And subscribe to Insurance World TV for more practical insurance insights. Until next time, stay informed and stay covered.